All right, let's get right into it. We are going to dissect one of the most significant shifts happening in global finance today, the ongoing challenge to the US dollar's long-held dominance. Now, this isn't just about currencies trading back and forth. It's a much bigger story. It's about ambition, it's about power, and really, it's about the slow, deliberate reshaping of the entire world's economic order.
Okay, before we dive deep, a quick but really important note. This entire analysis is for educational and informational purposes. We're here to unpack the complex mechanics of what's happening, but just to be crystal clear, this is not financial or investment advice.
So, here's our roadmap for today. We're going to start with what we're calling the De-Dollarization Dilemma. Then, look at the dollar's incredible staying power. After that, we'll break down the BRICS three-layer strategy piece by piece, examine the paradoxes and constraints they face, and then we'll map out three plausible futures for the global financial system. First things first, we have to properly frame the central tension of this whole thing. What exactly is de-dollarization? And, maybe more importantly, how can we actually measure if it's happening? You know, this single quote right here, it absolutely nails the core of the argument. What we're seeing isn't some sudden, dramatic collapse and replacement of the US dollar. That's not what the data shows. Instead, what's happening is a slow, gradual shift toward a more multipolar world. Countries are making changes around the edges. That's the marginal behavior. But the deep, systemic plumbing of global finance, that remains, for now, overwhelmingly denominated in dollars. So before we can really understand the challenge to the dollar, we first have to appreciate its foundations. I mean, people have been predicting the dollar's demise for decades, right? So why, after all this time, is it still so incredibly powerful?
While the dollar's power has really deep historical roots, you have to go back to 1944, to the Bretton Woods Agreement. That moment placed the dollar at the absolute center of the post-war monetary order, anchored to gold. And even after the US cut that tie to gold back in '71, the dollar's dominance was already so entrenched through trade networks and capital markets that it just continued, transitioning us into the fiat system we have today.
And let's look at the hard numbers, because they tell the story. As of 2024, the US dollar still accounts for a staggering 58% of all disclosed global reserves. The euro? It's a distant second at 20%. And the Chinese renminbi, despite all the headlines, is sitting at just 2%. I mean, that's it. This isn't just an opinion, this is the official ledger of the world's central banks.
This incredible dominance gives the United States what economists call the exorbitant privilege. Think about it. It's the unique ability to pay for everything you import and to finance all your national debt in a currency that you yourself print and that the rest of the world is forced to demand. It structurally lowers borrowing costs for the US and gives it immense flexibility.
And this persistence isn't an accident. It's really built on three unshakable pillars. First, the U.S. Treasury market is just unmatched in its scale and liquidity. Second, the pool of dollars available for global trade is deeper than any other. And third, there's a deep-seated trust in the U.S. legal system. To try and replicate these advantages from scratch, it's an almost impossible task.
Okay, so with that foundation in place, let's flip the script and look at the challenger's playbook. What are the specific mechanics of the BRICS strategy? How exactly is this bloc trying to engineer an alternative?
You have to understand, de-dollarization is not some single big bang event. It's a very deliberate three-layer strategy. Layer 1 is simply encouraging trade between countries in their own local currencies, which cuts down on the immediate need for dollars. Layer 2 is a slow, steady rebalancing of central bank reserves away from the dollar and into other assets, like gold. And Layer 3, which is maybe the most ambitious, is to redesign the financial plumbing itself, the payment rails, using projects like Membridge to create channels that bypass the dollar system entirely.
And we can see that second layer, the reserve rebalancing, happening in real time. Look at this number. In 2024 alone, central banks, many of them aligned with the BRICS bloc, bought a staggering 1,045 tons of gold. Now that's not some minor adjustment. That is a massive, strategic shift in asset allocation.
And this chart really puts that number into perspective. From 2010 all the way to 2021, central banks were buying about 473 tons a year on average. But since 2022, that number has more than doubled to over 1,000 tons annually. This acceleration is a clear, data-driven signal of a major shift, and it's largely driven by geopolitics and the desire to own assets that can't be sanctioned.
And this is a really crucial point, we have to be precise about what this means. Owning physical gold is about asset immunity. It's an asset that nobody else issued, that has no counterparty risk, and that doesn't rely on anyone's payment system. But it is not a direct substitute for the dollar's role in lubricating global trade. You can't pay for a supertaker of oil with gold bars. Gold is illiquid, it pays no interest, and it can't finance complex global supply chains.
And that brings us to the core operational problem for anyone trying to challenge the dollar. It's what we call the global liquidity paradox. It's the point where all the big ambitions run smack into the hard constraints of how money actually works.
It's a classic concept in economics known as the Triffin dilemma, and it's a real catch-22. To be the world's reserve currency, you have to supply the world with huge amounts of your money, which means running massive deficits and selling your bonds everywhere. But the very act of doing that, over time, can create imbalances that undermine the stability of your own currency. It's a paradox, and any country that wants to replace the dollar will face this exact same problem.
So when you compare what the world needs in a reserve asset, things like massive scale, deep liquidity, safety, and legal reliability, with the current reality of the BRICS nations, you see a huge gap. I mean, we're talking about a collection of very different economies. They have different inflation rates, they have capital controls, they have wildly varied levels of political risk. Trying to create a single, trusted reserve asset out of that mix is an immense, maybe impossible challenge.
Okay, so we've laid out the playing field. We see the dollar's fortress, and we see the challenger's strategy and their constraints. So, where does all this go from here? Let's game out 3 plausible scenarios for the next decade.
All right. Scenario A, which we see as the most likely baseline, is what we call a fragmented world. This is where regional currency blocks pop up and exist alongside a still dominant dollar. Then you have Scenario B, the digital hegemon, where new tech like central bank digital currencies creates a new way to settle payments, chipping away at the dollar's monopoly but not necessarily replacing it as a reserve. And then there's Scenario C, the resilient greenback, where the dollar's deep institutional advantages just prove too much to overcome.
So, what does this all mean for investors? Well, the shifting landscape really implies a need to rethink how portfolios are built. It probably means more attention on hard assets like gold, a much closer look at currency risks, and just generally being prepared for more volatility. And critically, it might mean we can't rely as much on that classic 60-40 stock and bond portfolio, because the role of U.S. Treasuries could fundamentally change in a more fragmented world.
All right, let's bring all these points together into one final strategic conclusion about the new monetary architecture that's taking shape right before our eyes. So let's be absolutely clear. The future we're heading towards is not a dollar collapse, and it's not the rise of a single new replacement. What we are witnessing is an evolution toward a much more complex, multipolar system, a system of managed fragmentation. The dollar likely remains an anchor, but it's just not the only game in town anymore. And this, right here, is the key takeaway. We have to reframe the whole debate. The old way of thinking about it, dollar versus BRICS, is just too simplistic. It's not a boxing match. The new, more accurate way to see it is a transition from a unipolar reserve architecture to one of managed fragmentation. Getting that shift in perspective is absolutely essential for understanding the decade to come. And all of this leaves us with one final, critical question. As this more complex world emerges, a world with multiple monetary centers of gravity, the great challenge for everyone is going to be navigation. How will nations, how will corporations, and how will individual investors adapt to manage the new risks and seize the new opportunities? The answer to that question is what will define the next chapter of the global economy.